So now we just have some math. Right? I want you to focus on being able to run through the math. I will always tell you the amount realized. And in this world, the amount realized is the insurance check, right? Because you are not selling your property, but you are being reimbursed by your insurance company. I will always tell you what your adjusted basis in the property was at the time of the disposition. And then it'll be your job to start with the math, right? The realized gain or loss is just the amount realized minus the adjusted basis. And then I'm going to have to tell you how much of the insurance company's monies you reinvested in suitable property. And from there, you will determine whether or not you have to realize any gain. And you will realize gain anytime you have not spent the entire amount of the insurance proceeds. So in our case, the reinvestment, if it's not at least $200, which it is only in case C, you will have some gain recognition because you've kept part of the insurance company's monies. The actual conversion was involuntary, but it's your choice whether or not you put all the money back into replacement property or you keep some of it back. If you keep some of it back, it's deemed to be coming out of the gain you would have realized. And so in each of these cases where there's a gain, to the extent that you put less than $180,000 back into the property, you'll recognize all of the gain. If you put back $195,000, you'll recognize 5 of the gain because you kept 5 of the insurance company's monies. All right, so we've got the slide where we're going to talk about each of these. All right, and we'll talk about how much gain we recognize, how much gain we defer, and then we will come back to the same set of numbers and we will figure out what our basis in our new property is. So case A is a loss. Losses do not apply this code section. Remember, losses would be recognized unless it's personal use property that does not qualify for a casualty. Case B, we did not do any reinvestment. We took our money and ran. So they treat this as if it was a voluntary conversion because I chose to keep all the money. So I'll recognize the full $20,000 and we're done. Case C, would have put $205,000 in. So we're going to get a full deferral of the gain because we put back all of the insurance company's monies and, in fact, we threw in more of our own. Case D, we're recognizing gain to the extent not reinvested. So we're recognizing 8 because we put 192 back into suitable property. So we kept 8 in our pocket. So we'll recognize gain of 8. We'll defer 12 because remember our total gain was 20. And so what we don't recognize, we defer. And then in case E, we're going to recognize all of it because we kept back more than 180. Right? So if we keep back more than 20, we'll recognize all the gain, but they can never force us to recognize more than we realized. Once you've determined how much gain deferral there is, we'll use our rule for substitute basis to determine what the basis in the new property was. So remember that was the cost of the new minus any gains deferred. So we don't need to deal with the loss side because involuntary conversion rules do not apply if you realize a loss. You go elsewhere to determine whether you're recognizing the loss or not. This is an elective provision, which means that you could recognize gain if you so chose. If you were a corporation, because remember this rule applies to corporations and individuals, you might want some capital net 1231 gain to offset some 1231 losses. An individual might feel that they're in a zero tax bracket for capital gains right now, and so they would rather pay the zero tax now than risk having the gain trigger later when they might have to pay a 15 or 20% tax on the gain. So it really just depends taxpayer to taxpayer on what they want to do. To figure out the substitute basis, you have had to have done everything we've already done, which is to generate our realized gains or losses, to look at how much we reinvested, to determine if we have any deferred gains. All right, to the extent we have deferred gains, we're going to reduce the original cost or the amount we reinvested by the amount of the deferred gains. So we'll go to the next slide and we will determine our bases in all 5 properties. All right, so we start with the purchase price of the new, which is actually doesn't concern us in A and B. A, because it was a loss. B, because we didn't spend anything on new stuff. And so the loss went elsewhere to see whether or not we could use it. And in B, we recognized the full gain. So we only have to deal with cases C, D, and E. And technically, we don't have to deal with E either because we didn't defer any gain. We spent less than 180, so we recognized all of our gain. So we were not exactly under this provision. So you can see the way math gives us. In case C, we have a higher basis than we started with, but we put in more of our own money. In case D, we come right back to where we started, and that's what you'll get as an answer anytime you have a partial gain deferral, because you're simply taking the cost that you spent, the insurance company's money, the 192, backing out the amount that relates to gain you have not yet paid a tax on. And so you are going to come back to case D, where you're just right where you started, as long as you have a partial gain deferral versus a full gain deferral. All right, so then we have some other complications here. Once again, I'm not going to read these slides to you. I am not going to test you on them, but that doesn't mean you should shut down your ears just yet. All right, you should know a little bit about this material because it could turn up in your corporate class. Condemnation simply mean that the government has determined it has the right to force you to sell. And then there is a fair amount of confusion about what qualified replacement property has to be. And the rules are different whether you are a renter or an owner of the property. I'm leaving the slides in here. Curious minds should take at least a look at them, just in case I would give you a question, which I just said I wasn't going to. But you're curious, so you should at least take a second or two to build that first level of deep background. You never know what might show up on the CPA exam. And then the replacement period is generally the 2 years plus this year, but on the right set of circumstances, you might get a little longer. All right, so this slide just talks about all the different ways your property could be condemned. All right, now that last bullet is interesting. You were getting ready to move anyway. The space was too small for you. You get a notice that in 2 years, the government's going to take your property because they usually do have a pretty long lead time on these things. You don't want to wait 2 years. You want to sell the property now so that you can go about your life. And then you go, well, who would actually want to buy the property knowing that the state's just going to take it away in 2 years? And the answer is 2 different kinds of companies. One where they need some extra space for a temporary expansion. Your space might suit them quite well for the short term. And the other is a group of people who always think there's a nickel extra to be made. Right? They're really good negotiators. They're absolutely convinced that they can force the government to pay more than the original condemnation price. Plus, they're probably not going to offer you top dollar here, right? If they know that they have to sell it to the government for $200,000 in 2 years, they're probably going to offer you 160, 180. So they have a built-in profit if you ignore the time value of money, and they have the potential to make even more, they think. And then these slides just talk about whether its property has to be similar or like kind. We're going to talk a lot about like kind property when we move to that section. So just note here that if you have a renter or a owner who have had a involuntary conversion, you're going to have to check the rules to figure out what will be a suitable property. And then 162, remember, that's our trader businesses. Section 212 is our investment property. So if it's your business property that is involuntarily converted, you get an extra year to reinvest, and then you're going to follow the like-kind rules that we're going to talk about in a few minutes. And I am going to spend time on the like-kind rules because they are important. And so since you're most likely in your corporate class to be talking about business property, you'll already know the rule you need, even if you slept through the last slide. And so we're going 1031 is the code section. It's the like-kind property. And that's where we're going next. So like-kind exchanges, you deal with these in your GAAP classes, right? You swap out a new car for a old trade-in, probably the most likely place you saw it in your GAAP classes. All right, so we're going to talk about why people would want to do this, and then what qualifying properties are, because it's important here. And then the like-kind requirements is different for buildings and the land under them than it is for equipment. Personalty is the lawyer word for equipment. So in all cases, you still have to figure out your gain or loss realized, right? Amount realized minus adjusted basis gives you gain or loss realized. Gains will be recognized if you have acquired boot, which we'll define in a minute. Losses are never recognized. So that means that we have two absolutes as we finish up the semester, right? In the last set of slides, a net 1231 loss is always ordinary, end of story. When you engage in a like-kind exchange and you realize a loss, you will not recognize that loss, end of story. And then, of course, we have to worry about our basis adjustment. And this time we are going to decrease for gains not recognized and increase for losses not recognized, just like we did with the wash sales. It's important to note that usually a like-kind exchange involves big ticket items. Their rules are very complicated. The lawyers get a big payoff. And so you would never want to encourage someone to engage in a like-kind exchange to defer $10, $15, maybe even $50,000 worth of taxable income, because the fees would eat you up. The second thing of interest is that usually the person who is making the exchange is not the one to have initiated the activity. I own some land. I'm perfectly happy owning that land. I am confident that sooner or later the train or the shark pump equivalent are going to come and I'm going to make a killing. But somebody else needs my land right now. I see absolutely no reason to sell it because there's nothing else I really want to buy. And I'd have to pay taxes anyway, right? So if I'm looking at $1 million worth of gain and I'm only going to keep 60% of that, that doesn't give me $1 million to reinvest. So I might be reluctant to make the exchange. So the person who has a vested interest in acquiring your property is going to be the one who designs a deal that can get you to swap out what you own for something else, hopefully equally good for your purposes, that will allow the other person to have immediate access to your property. And then the other time the exchange can take place, would be initiated by the person who owns the property, is you're just tired of being in activity A and you want to be in activity B. And so you want to structure the transaction so that your cashing out of activity A has the lowest tax cost. And that'll make some sense as we go on. So this is not an elective provision. So if you engage in a like-kind exchange and you do it perfectly, remember, you do not get to recognize your losses, which could make you unhappy. So you might want to flunk the rules for like-kind exchange some of the time. There's no gain or loss recognition if property is exchanged for like-kind, which we'll define, used in a trade or business or held for investment, and no boot is received for gain recognition. So I have to have a profit motive, a 162 or section 212 on either side. All right, so I am a chicken farmer and I'm really tired of being a chicken farmer. So I might want to sell out my chicken farm and buy a rental property. All right, I could do that as long as I meet the requirements, and I could minimize my gain recognition if I engaged in a like-kind exchange. Otherwise, if I sold my chicken farm, I'd have to pay taxes on all the gain, and it would only be the net proceeds I could invest in a shopping mall or whatever I might want to invest in. And remember, boot, we're going to define it. Boot is anything that's not like-kind. That's the short answer. If you receive boot, it's the same as with our involuntary conversions where you kept back some of the insurance proceeds. You made a decision to cash out on part of the property, and so you'll recognize gain to the extent that you cashed out. Losses, remember, are never recognized in a like-kind exchange. This slide simply covers the list of things that would never qualify for a like-kind exchange. So selling inventory or swapping out inventory, swapping out Apple computers for IBM computers or Apple computers for Apple iPads would never get you under 1031. Partnership interests cannot be swapped here, even if they both have identical properties in them. Stocks, bonds, securities cannot be swapped. So if you were planning on swapping your Apple stock for IBM stock, this is a fully taxable event. And then restructuring debt is almost always a taxable event. I said we would talk about what is like-kind. And as we noted earlier, real estate and the land under it gets treated differently than equipment. In both cases, you have to have the trade or business and investment connotations on both sides. A building I'm holding for investment could be swapped for a farm I intended to work, or vice versa, as long as I have a profit motive on both sides. So the realty is broadly construed. So literally, a gold mine could be swapped for a downtown office building. I mentioned the farm. If I was going to swap out my chicken farm, the buildings and the land would be, and the fences attached to the land would be treated as realty, but my chickens and my feed and those kinds of things would not be. And so I basically would have some boot. Remember that stuff that's not like-kind. If somebody took my entire chicken farm over and I got a rental complex in exchange. So any real estate for any real estate, including the ground, a gold mine for a building counts just fine. Equipment, personal equipment, has a functional use test. So it's still pretty broadly construed. Substantially the same as the original property. So I have here two different kinds of vehicles on wheels that are used to move stuff around. They could be swapped one for the other. One office machine could probably be swapped for another office machine, but you couldn't swap an office machine for a truck. You would be going too far if you went there. Once again, these are very complicated rules. If you were to become a tax practitioner in a firm, they wouldn't let you touch this until you were at least a manager. You might get to do the paperwork, but you would not get to do any planning at all because it's just high dollar amounts, high stakes, complicated rules, and you've got to dot every I and cross every T or you'll have a blown event. So boot is everything that is not like-kind. So back I mentioned my chicken farm. If you take my farm and my chickens, whatever I get for the chickens would be a taxable event because I'm swapping chickens for land, and that's not like-kind, right? So property that's not like-kind, non-qualifying property, you give me some stock, you give me some cash, any net debt relief. Right? I owed $20,000 to the bank on my chicken farm. You pay off my mortgage. That's the same as if you gave me cash and I paid off the mortgage. I note it says net debt relief here. So if the chicken farm had a $20,000 mortgage, but the building that you're giving me has an $80,000 mortgage, I didn't have any debt relief, right? I'm actually further in debt by another $60,000 when our swap is over. I've said repeatedly that this is a very complicated area. We are only going to touch our toe gingerly into the water. Our focus will be the computation of the gain or loss and the related basis adjustment. The effective liabilities, we've already talked about that, right? If we have net debt relief, we have boot, and boot would cause us to recognize gain. We never recognize losses on a like-kind exchange. And then life can get really complicated, and we're not doing either of these last two bullets, right? Deferred exchanges. You really, really want my land, and I'm such a picky Nicky, and I've spent months, and you haven't been able to convince me that you found the perfect property for me. And so it is possible, once again, if you want to pay more lawyers' fees, if I never get to touch the money, if it's put in an escrow account, it would be possible for me to turn the title for my land over to you. The lawyer keeps the money, and I spend a reasonable period of time finding the right property. And then I direct the lawyer to purchase it from the escrow account. That is treated as if I never touched the cash, and it could be a qualifying like-kind exchange. But like I said, your lawyer fees are probably doubled now, and there are now lots of extra places where you can make a mess and have to gain recognition. And then related parties are always an issue. So there are lots of extra rules if the people in the swap are related. Remember, as you move to your corporate class, you are related to your corporation or your partnership if you meet certain ownership requirements. And so you want to be alert to any related party transactions between the corporation and the shareholder, because they're just going to make your life miserable. Computation of gain or loss, whether or not you have any deferred gain or loss, and your basis adjustment, that is the only thing I'm going to test you on, right? And so once you've calculated your gain or loss realized, your gain is realized to the extent of the fair market value of the boot. Remember, that's the same as if I kept some of the insurance company proceeds in our involuntary conversions. We're doing the exact same thing. Right? Losses are never recognized, even with boot. So if I engage in a qualifying like-kind exchange, I will always defer my losses. When you defer losses, the basis in the replacement property gets bigger. When you defer gains, the basis in your replacement property gets smaller. So I got the same situation here. I've got 5 cases. And you'll note that I am setting up the amount realized, breaking it into like-kind and boot, because when I determine I have a gain, I want to be able to easily determine if I have any gain recognition because of my boot. All right. And in this slide, I have also broken my like-kind into my amount adjusted basis into both like-kind and boot. We are not going to deal with the complexities of the boot. So if we give boot, it'll just be cash. In the real world, if that boot consisted of stock, I would actually have to calculate the gain or loss on the sale of the stock, because the stock being swapped for land could never be like-kind. But we're not going to go there. What you'll want to concentrate on is generating your gain or loss realized, and then simply tracing the gains up to see if you have any boot. So in cases A and B, I have a loss. I never recognize a loss on a qualifying like-kind exchange, so the boot don't matter. So I'm going to defer the 25 and defer the 4, because that's the rule. In cases C, D, and E, I am going to recognize as much of the gain as I have boot in my pocket. So we'll trace the 12 up to the boot line in C. There's nothing there. That'll give us an answer. In case D, we'll trace our gain realized up to the boot line and see we got lots of boot. And we'll do the same thing in E. So we're going to do that on the next couple of slides. So remember, losses are not recognized if 1031 applies. So A and B, we will have no loss recognition. We'll defer the total loss. In C, there was no boot, and so there's no gain recognition, because when we traced our fingers back up to the boot line, there was nothing there. And they can't force us to recognize more than we realized. So in case D, the boot was 15, but we can never recognize more than we realized, so we are only going to realize 10. So we basically cashed out some of our bases for the extra 5. And then case E, we have the perfect situation where there's some boot and some deferral. So we had 15 of total gain. I'm sorry, 25 of total gain, 15 of boot. So we will realize 15 of the gain and defer. So the next step is my substitute basis. Remember our rule. We're going to take the basis in the new property. It's going to be the fair market value of the like-kind property received. And that's why it's useful if you take a minute and break up your amount realized into the like-kind and non-like-kind, because you don't want to get confused, right? And then we reduce by the gain not recognized. We increase by the loss not recognized, right? The book has a second method for doing it. Do ignore it completely. It gets you mathematically to exactly the same place, but it's way too late in the semester to make life complicated. This way always works. The fair market value of the new property, the like-kind new property, minus gains not recognized, plus losses not recognized. And of course, it'll either be 1 minus or 1 plus, right? All right, so let's put that to work. All right. So in each case, the fair market value of the like-kind property was $100. And this is just a reminder that in A and B, there were losses. So we didn't have any gain deferral there. And then we deferred 12 of gain, none gain, 10 of gain. And so the losses deferred in the first two cases are going to be added to the 100,000. So you can see our answers for our new basis, right? 125, 104, 88, 190. So what I am expecting on your last mini quiz is that you can calculate the gain or loss realized, the gain recognized, the gain deferred, and then be able to do the basis adjustment. Then we've got a couple slides to close out. Related parties. I want to make sure that as you, for some of you moving into your corporate class, you understand about related parties and the fact that they're going to complicate your life, right? Related parties include immediate family members, and in some cases, those immediate family members can be in-laws, your ancestors, like grandparents, your children, your brothers, your sisters, your nieces, your nephews, sometimes, not always, and any more than 50% owned corporations or partnerships. Now, as you move into your corporate class, pay attention. You're going to get lots of rules focused just on corporations. So it'll be a much more focused class. Chapter C of the Internal Revenue Code will be essentially all that you're doing. A lot of times you're going to have a rule that is 50% or more, other times greater than 50%. If Dr. Edmonds is teaching the class, they are closed book quizzes that are very useful. You want to be prepared for them, and closed book tests. So it's important that you gear up your memorization. Right? So anytime there's a rule, pay attention to whether there should be an equal sign with the greater thans so that you don't land up losing points because you weren't organized. And then attribution rules mean that sometimes what your mother owns is treated as being owned by you. And so you may land up having only a direct ownership of 20%, but you could land up, once you apply all these rules applied to your mom and then the same rules applied to you, you could land up owning 60%, which in your corporate class can have some pretty drastic ramifications. Right, so when you do have a related party loss, this works pretty much like a depreciated gift. Remember, if you give a piece of property away that you spent 50 for, that's only worth 10. If your donee sells it later for more than the bottom price, they get to add some of that loss you would not have recognized. In our related party sales, it works exactly the same. The mechanics are to add to your amount realized, to your adjusted basis, so that your adjusted basis actually gets bigger by the amount of loss. But that's just words, right? Same thing. If it was worth 10 and you had paid 50 for it, you would have had a potential loss of 40. If instead you sold it to me for that bona fide $10, you would not get to recognize your 40. But if I sold it for more than 10, I could use part of that loss you didn't get to recognize. Right? So property is not sold for a gain by the subsequent owner. The disallowed loss never gets used. But that was the same thing for the gifts, right? And then remember that this is not you're cheating, right? If 10 was the best anybody would have paid, and in fact, I conned my brother into paying me 10 when I knew I could only get 9 elsewhere, this related party disallowed loss rule does still apply. And then just a couple of words on NOLs. That's a net operating loss. We're not doing any of the calculations. All I want you to know is if you net negative on a tax return, life gets very complicated. Never file a tax return with negative taxable income without shooting it up the chain and getting someone with more responsibility to make the decision as to whether you need to file the return or you need to extend the return so you can figure out what to do with those NOLs. Right? So we're talking about NOLs limited to a trade or business. So you may have a negative taxable income as an individual, but if it's being caused by your Schedule A and other items, you probably don't have an NOL. The good news is the IRS has very good forms to help you figure this out. Right? So there's a lot of stuff you have to adjust. I'm just listing them here. We are not going to do an NOL calculation. I just want you to note that just because you have negative taxable income does not mean that you have an NOL, especially when you're on a Form 1040. And the reason why you don't file that return without spending some time thinking about it is the alternative minimum tax. Remember our AMT? The NOL calculation for the AMT is a different number than the regular tax. So it would be possible to cheerfully carry back your regular tax NOL just to trigger an AMT tax at 26 and 28%. And if you did that, you just threw away your NOL. So if you have a net operating loss, it's important to look at what the carryback of it would do to your potential refunds and the impact of AMT. And so that's why you never, never, never want to make an automatic filing without thinking about it. You could cost your client literally tons of money, and there's no redress, right? He could come sue you, but the government's not going to let him change his mind. All right, so the NOL election can only be made on the tax return as it's filed, right? And so there are general rules for how far you can go back, and they bounced all over the place. All you want to remember is if I want to do the carryback, I have to tell the government that I'm going to do the carryback on the tax return that generated the loss, and I cannot amend the return to do it. So if I file the return with nothing being said, the presumption is I'm going back, and go back I will, even if I land up losing money because of the AMT regular tax interaction. So if I don't go back, I just go forward. And remember that if I do nothing and simply file that return, I have to go back before I can go forward, even if I'm sad about it. Irrevocable means there's no way to change your mind. You are just stuck. That was our last slide on our last set of slides, and we are done. I just wanted to take a minute and thank you all for being good sports while I figured out how this was going to work. I hope you all learned something. At least you learned how to get your brain working better. You really have been experiencing what a real life practice would be like. Right? It's going to be confusing. It's going to be irritating. It's going to be demanding. And it's going to expect you to be in the game every day. And most of you will absolutely love it. Right? It's a whole lot more interesting than working at McDonald's or selling shoes. But it is challenging and demanding. And it is important that you recognize that as you move forward to finish up your accounting degree and move into the real world. See you in the halls. Bye.